Get Rich Education is brought to you by Ridge Lending Group, Apartment Investor Mastery, and Producers Wealth.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to GRE, Get Rich Education, episode 184. Hi, I'm your host, Keith Weinhold. Interest rates have been on the rise, and we've got more signs than ever that they could soon rise even higher. And for a credit-based asset like real estate, that's obviously got some major implications for you. Macro Watch's Richard Duncan is going to be here to provide some interest rate predictions and perspective for you in just a bit here. Since your mortgage is your greatest expense as a cash flowing real estate investor, your cash flow pinch is obvious in a higher interest rate environment. That is a bad sign for you in the shorter term. There's just no doubt about it. In fact, since a year ago, rates are up 0.5% or so. They're still so low historically. I check rates at mortgagenewsdaily.com, by the way. Now, if you think that 30-year fixed-rate mortgages are going to be, say, 7% in 4 years, well, then you probably want to buy as soon as you can. But over the intermediate to longer term, think about what these higher interest rates do to your tenant pool. Okay, so in the short term, it hurts you on your purchases. But over the longer term, with lower home affordability due to these higher interest rates, there is a certain lag effect, but that means that your tenant pool will soon increase. So with this greater rental demand at the same supply, your rent income increases. Now, most people understand that, but what do higher interest rates mean to housing values? Now, this is something that fewer people understand. Higher interest rates often mean higher housing prices. How can that possibly be true? That seems like a complete paradox. Higher interest rates mean higher housing prices? Well, higher interest rates are typically put in place by the Fed to slow an economy and a labor market that's heating up. And long-term rates, which is what mortgages are tied to, they're not directly tied to the Fed's moves in the short-term funds rates, but there's a more loose correlation there. A hot economy and tight job market means that people can afford to pay more for a home because the economy is doing relatively well. Now, let's just talk about primary residences for a minute here. That way we can leave income production out of the discussion and just talk strictly about housing value here and how in the heck else higher mortgage interest rates could possibly mean higher housing values. Now, for wannabe first-time homeowners who are just trying to get into the market with a starter home, high mortgage interest rates are probably the worst for them. Understand that first-time homebuyers, though, they are the minority of homebuyers. Let's look at the majority of homebuyers. The majority of homebuyers are existing homeowners. So say that you are an existing homeowner and you have a mortgage with a 3.5% interest rate. That actually happens to be the rate on my own home. Well, with a credit-based asset like real estate, selling your existing home, that also means that you need to sell your low 3.5% interest rate in order to splurge for a move-up home. Well, that might all seem less appealing to you if that move-up home also comes with a 5.5% interest rate in addition to its higher price tag because it is a move-up home. People buy more on an overall mortgage payment than an overall price. So instead, more homeowners then will just stay put in a rising interest rate environment. So with more current homeowners at all prices wanting to stay put, that means that there's less supply on the market. Less supply on the market correlates with an upward tug on home prices. That's because borrowers would have to give up below market financing in order to sell their home. Instead, for that one borrower, they then might choose to delay both the sale of their existing home and the purchase of a new home, all in order to maintain the advantageous financing situation that you're currently in. So now that's two sales that could have happened but don't due to higher interest rates. So that's how it substantially constrains supply. And this is why oftentimes rising mortgage interest rates do not lead to falling home prices. In fact, over the last 25 years, there have been 6 different periods where mortgage interest rates have risen at least 1% in the U.S. Okay, 6 different periods. And what happened during those 6 periods that interest rates increased substantially? Housing prices increased every time. 6 substantial interest rate increases, 6 times we had rising house prices. I'll link you to a recent article about that in the show notes so that you can look into it yourself. Now, I've been following Richard Duncan's Macro Watch video newsletter, and I've noticed that there are really a lot of interesting trends conspiring such that interest rates could rise not just a little, but substantially in coming years. And there are a whole lot of factors there. So we're talking in terms of probabilities rather than certainties, of course, but there really are a few, I guess, different economic conditions unfolding, and I want you to be able to plan accordingly for your largest expense as both an income property owner and primary residence owner. So we're going big picture today as we're talking about predicting trends with one of the world's great macroeconomists joining us from Thailand right after this. For an income property investor like you that needs an income property loan, go to Ridge Lending Group. And over the years, you've heard owner Chaley Ridge generously give her time to you right here on the show as a guest. Ridge provides investment property loans in almost every U.S. state, and you're going to find out how they've helped more Americans realize their dreams of financial freedom through real estate than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president of Producers Wealth. Producers Wealth assists people in creating, protecting, and perpetually multiplying wealth in any economy through creating processes that help them increase their production, provide them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
Today's guest was actually the first ever guest to appear on Get Rich Education back in late 2014. He's the author of 3 books on the global economic crisis, including the international bestseller, The Dollar Crisis, Causes, Consequences, and Cures, which forecast the global economic crisis of 2008 with extraordinary accuracy. He began his career as an equities analyst in Hong Kong in 1986. He was the global head of investment strategy in London. He was the financial sector specialist for the World Bank in Washington, D.C., and he headed equity research departments in Bangkok. He also worked as a consultant for the International Monetary Fund in Thailand during the Asia crisis. He is now the publisher of the video newsletter Macro Watch, which can be found on his website, richardduncaneconomics.com. Welcome back to Get Rich Education, Richard Duncan.
Hi, Keith. Thank you for having me back.
Richard, so much has happened in the world economy since you were last here. Some of it was surprising and some of it was expected. Quantitative easing ended about the time you were last here in late 2014. We had the Brexit vote. We had Donald Trump winning the election. More recently, we had a new Fed chair. Janet Yellen is out. Jerome Powell is in. And you study a lot of world economies, but I thought it was a good year to have you back because you've done a lot of work on U.S. monetary policy so far this year. So just tell us a bit more about your background so we kind of know how your ideas evolved first.
Very briefly, I started off my career in Hong Kong in 1986 doing research on the Hong Kong stocks as an equities analyst. And that was important because I saw China and Hong Kong in the late 80s, and it became clear that that was going to cause deflationary pressures in the United States because there I could see factories as far as the eye could see stretching into China's distance with full of young women working for $3 a day. And so clearly, if we had a free trade environment, that was going to push down prices and be very deflationary and therefore push down interest rates. So that was one important point in my career. I mean, something that I think was important for me to see and shape my view of the world. And then later, I moved to Thailand in 1990 and stayed here for 6 years and watched the great Thailand bubble form and then pop in 1997. And so seeing that economic boom and bust in such a short period of time, that also taught me a great deal. I always say I had my education in bubblenomics in Bangkok during the early 90s.
Yeah.
Immediately after that, I worked for the World Bank in Washington for a couple of years. And that was interesting to see what they knew and what they didn't know. And soon after that, I wrote my first book, The Dollar Crisis, and then moved on to be global head of investment strategy at ABN AMRO Asset Management in London, looking at all asset classes globally. And then the crisis of 2008 struck, which was not unexpected because that was what I was writing about in The Dollar Crisis. What was very interesting afterwards was to watch the policy response, watch the Fed respond with quantitative easing, creating $3.5 trillion from thin air and using it to buy bonds, pushing up bond prices and therefore pushing down interest rates. That's a quick tour of the things that have affected the way I view the economy and the financial markets.
So one of those early influences was you saw Chinese factories and how that could suppress inflation rates and how that could suppress interest rates. You saw the advent of where in the United States soon we would have lamps made in China, shirts made in Vietnam. So that pushed down prices for goods in the United States and that also suppressed wages in the United States because now those jobs could be outsourced to lower cost of living places like Asia. But maybe just kind of an economics 101 or really maybe economics 201 thing here. Explain why low inflation pushes down interest rates.
If the inflation rate is 5%, no one is going to lend you money for 5% because the real return on that would be zero. So typically people like to have a 3% real return, and so they would lend you money for 8%. So if the inflation rate goes to 10%, then they're going to lend you money for 13%. If the inflation rate goes down to zero, they might lend you money for 3%. So that's why.
Asset prices are stretching out there. We've had these low interest rates for such a long time, a decade or more, and many people predicted that they would be higher by now. And most predict that we are going to see higher interest rates still, and we have begun to see that. We've seen several quarter-point increases in the federal funds rate. And let's just talk about, sort of the why behind this. The reason why policymakers want to increase interest rates typically, and I just want you to jump in if you want to add any color to this, is higher interest rates are a tool to cool an overheating economy because higher interest rates, that discourages people from making new investments, and that discourages new businesses from starting up. Tell us more about high interest rates and just the why for changing policy that way.
Yes, I mean, that's exactly right. The Fed tries to prevent inflation from moving too high. So if they're afraid that the economy is going to become too hot and unemployment is going to be very low, that would cause a wage price inflation, and that would result in a wage push inflation spiral similar to what we saw in the 1970s. So the inflation rate is below the Fed's target. It's still below 2%, but it has moved a little bit higher. So that it is true that the Fed can control the federal funds rate. That's the short-term interest rate, overnight interest rates. So government does have an influence on the interest rates, but the market also has an important influence on interest rates as well. Interest rates are determined at the long end, long-term interest rates, by the supply and the demand for money. And so regardless of what the Fed does with the federal funds rate, the rate that it controls, you can have a situation where the long-term interest rates move higher than the Fed would like to see or remain lower than the Fed would like to see. And so now what I'm concerned about is that market forces, rather than only Fed policy, will push up interest rates. It is true that the Fed has been pushing up interest rates at the federal funds rate, short-term level, but I'm increasingly concerned about what's going to happen with the longer-term interest rates. And those longer-term interest rates, of course, the 10-year government bond yield, that is what determines mortgage rates. And of course, the mortgage rates directly affect the property market. So let me explain why I'm worried. Several things are happening now that suggest that market forces are likely to push long-term interest rates higher. First of all, after the tax cuts at the end of last year and the bill to increase government spending that passed in early February, it looks like the U.S. government budget deficit is going to be very much higher. It looks like it could be as high as $1 trillion this year, up from about $670 billion last year. And then this is just going to get worse after that. Next year, it will be 1.1 trillion and then 1.2 trillion, roughly. These are estimates.
Okay, just to clarify for our listeners, we're talking about the annual deficit, not the overall cumulative debt over the years, which is 21 trillion. We're talking about the annual deficit here.
That's right. How much the government will have the deficit this year, which means how much extra the government will have to borrow each year. So this year, the government's going to have to borrow roughly $1 trillion more in addition to all of the debt that it had before. And so other factors being the same, when the government borrows more, that tends to push up interest rates. At least back in the olden days when we were still on a gold standard or the Bretton Woods system, there was only so much money in the world. And if the government borrowed more of it, that demand for money pushed up the interest rates, and they called that crowding out because that made it unaffordable for the private sector, individuals and businesses to borrow at the higher interest rates. So it looks like we're moving back into a period of crowding out. Now, these budget deficits, that's one problem. In addition to that, the Fed is reversing quantitative easing.
Right.
So what that means is, your listeners, I believe, will recall that the Fed, in 3 rounds of quantitative easing, they created completely from thin air $3.5 trillion. And they used this new money that they created to buy mostly government bonds and bonds issued by Fannie Mae and Freddie Mac. And so they pushed up the bond prices, and that pushed down the bond yields, pushed down interest rates. Every time they did that, the stock market went considerably higher and interest rates went lower. And this was key in bringing about the revival in the economy once the crisis was underway. This was the main thing, or at least one of the main things that caused the recovery to come about. But now they're doing the exact opposite. They are, in effect, selling the government bonds that they had acquired in the past. And that means someone else is going to have to buy those bonds. And so you have a situation where not only is the government going to have to borrow $1 trillion a year for the next 3 years, each year, but the Fed is going to be selling roughly $400 billion of government bonds this year and $600 billion next year and another $600 billion the year after that. And so, in effect, when the Fed sells these bonds, it's the same thing as the government having to sell new bonds. You've got the government selling bonds to finance its budget deficit, and you have the Fed also selling all of these bonds to reverse quantitative easing. And that is very likely to push interest rates significantly higher, just as quantitative easing pushed them lower.
That's right. And many have characterized this as quantitative tightening, and we've now begun our cycle of quantitative tightening. We actually began it back in late 2017. So basically, this has the effect of where quantitative easing effectively printed money. We're now, with this new cycle of quantitative tightening, we're destroying money. So it seems sort of like an extreme move to me. Let me know what you think. But previously, maybe the Fed would steer interest rates, but that wasn't enough. So now we're introducing these extreme measures of quantitative easing 10 years ago and quantitative tightening now, destroying money.
Well, yes, that's exactly right. That is exactly what they're doing. By selling these bonds, technically this destroys money. So this is a very significant shift from what we've seen in the past several years. We're moving from an extremely loose monetary environment to an increasingly tight monetary environment. And in addition to what's happening here, overseas, the European Central Bank has been creating a great deal of money. They've been doing their own quantitative easing on a very aggressive scale. At the peak, they were printing 80 billion euros a month. Then last year, that moved down to 60 billion a month. And as of January, they're only printing 30 billion euros a month. And by printing so much money, that has held down European interest rates at very low levels. In fact, the German 10-year bond yield is only half of 1%, whereas the U.S. government 10-year bond yield is 2.3%. So the low European interest rates have helped hold down the U.S. interest rates. But as of September, the European Central Bank is expected to stop its quantitative easing also. So you're going to see more monetary tightening from Europe as well. And jumping back to the Fed, yes, like you said, they started this quantitative tightening in October last year. For the October, November, December, they sold off $10 billion of bonds a month. Then the next quarter, the quarter that just ended, they sold off $20 billion of bonds a month. Now, beginning in April, this quarter, they're going to sell off $30 billion of bonds a month. And then the next quarter, it goes to $40 billion. In October, they begin selling $50 billion of bonds a month. So this is going to be really extreme, I would even say radical monetary policy tightening.
Yeah.
And it looks to me that it's likely to push interest rates considerably higher.
And we're talking about interest rates for everything from mortgages to credit cards.
Well, let me add one more factor to this recipe of disaster, one more ingredient, and that is trade and this looming trade war that
right.
already seen the first shots fired. So one of the main reasons that inflation has been so low in the United States is because after 1980, the U.S. started buying more and more goods from ultra low wage countries like China and Vietnam and Indonesia. And so that pushed down prices, that pushed down inflation, and that pushed down interest rates. So now our current account deficit, our trade deficit, is roughly $550 billion a year. Now, every country's balance of payments has to balance. That means when the U.S. has a $500 billion a year trade deficit, it will have a $500 billion of capital inflow into the United States to finance that deficit. That may sound a bit complicated, but think of it this way. It's just like a family. If a family spends much more money than it earns, it has to borrow the money from someone or else sell off some of its assets to make the books balance. And it's the same with the country. So for many decades now, we've had these very large trade deficits, which mean that we've had very, very large capital inflows. But now President Trump, during his campaign, promised to eliminate the current account deficit. He promised to eliminate our trade deficit. And if that were to occur completely, and of course it's not going to happen overnight, but the smaller the trade deficit becomes, then that means the less capital that will come into the country from abroad. And this capital that's been coming in from abroad has been helping in a very large measure to finance the government's budget deficits. For instance, last year, the government's budget deficit was about $670 billion. The capital inflows were about $550 billion. So they financed almost the entire budget deficit. But now, if trade deficit becomes smaller, the capital inflows will become smaller, there'll be less money available to finance these much larger budget deficits. And that will be another reason interest rates will move higher. And on top of that, related to trade, of course, if the United States imposes trade tariffs on goods made in China and Mexico, and during the election, candidate Trump said he was going to put a 45% tariff on everything from China and a 30% tariff on everything coming in from Mexico. Well, of course, that would immediately cause the price of everything sold in Walmart to jump by somewhere between 30 and 45%, which would at once cause a very significant spike in inflation. And so not only would you have supply and demand for money pushing interest rates higher, but you'd also see a spike in inflation, which would also push interest rates higher. So this is really a very toxic combination, very unhealthy environment for the outlook for investors and the financial markets if we could move ahead with this trade war, which we have done. Just yesterday, China imposed significant tariffs, I believe, on 180 American products categories, including pork.
Well, this is really interesting. And, now listeners, when they think about Trump tariffs, they can think about how that potentially leads to a trade war and how that can lead to pinching our capital inflows. And that's really something that right there, that's a trend that begins to reverse globalization. And globalization is a deflationary force. So when you've got reversing globalization from tariffs in a trade war, that right there can increase inflation and increase the interest rates. I just think you're bringing up that there are more forces. There are just so many layers out there in the economy that portend toward higher interest rates.
Yes, that's right.
Real estate investors really need to think about what they want to do, and they want to buy before rates go up. And high rates are definitely bad for home buyers, but that can potentially be good for landlords because if fewer people can afford homes, they more often need to become our renter. But high prices obviously are bad for our own future purchases. So this does help us plan accordingly. Richard Duncan, any last thing, especially with higher interest rates, that you want to let the listeners know about?
Well, I'm sure I don't need to point this out to your listeners, but of course, if we're looking at an environment of considerably higher interest rates moving ahead, everyone needs to have fixed rate mortgages and not floating rate mortgages. Interest rates are likely to move higher. So if you haven't locked in your mortgage rate by now, you should do so. If things go the other way unexpectedly and rates move down, then you can refinance again and lock in at a lower rate if that ever happens. But we may have seen the lows for the mortgage rates, perhaps for our lifetime.
Exactly. I don't think we've been in an environment for a while where an ARM, an adjustable rate mortgage, makes sense. I've long been a fan of the 30-year fixed rate mortgage, and this right here is just another reason why that's probably best. Well, Richard, I know you have an offer for our listeners because what you offer, it really helps us forecast trends and some of these macroeconomic things that we're not thinking about sometimes. Tell us about that.
I produce a video newsletter. Every couple of weeks, I do a new video. It's essentially me making a PowerPoint presentation. In these videos, I describe what I believe to be important developments in the global economy, things like we've been discussing today, and how they're likely to impact the stock market, interest rates, property prices, commodities, currencies, gold, for instance, oil prices. I produce a new one of these videos every couple of weeks. It's called Macro Watch. And so if your listeners would visit my website, they can see more about it. My website's richardduncaneconomics.com. The product is called Macro Watch. Normally, the sales price is for a one-year subscription is $500, but I'd like to offer your listeners a 50% discount. If they go to the website, click on the subscribe button, and use the discount coupon code GRE, they can subscribe for $250 for a year. And with that, they will immediately have access to 42 hours of the videos that I've made in the Macro Watch archives and a new video roughly every 2 weeks for the next year. I hope they'll go there and look at what I'm offering and at least sign up for my free blog, if nothing else.
I'm a Macro Watch subscriber myself. If you just get one or two good ideas that help you make important decisions in your portfolio, it could very well be worth it. Check that out again at richardduncaneconomics.com. Richard Duncan, thanks so much for coming on to Get Rich Education.
My pleasure, Keith. Thank you.
Oh, thanks. Great stuff, Richard. Yeah, there's a lot to consider there. This week we went macro, and next week we're going to talk about just what makes a good income property provider for you. And I'll also tell you about the real estate investing field trip that I made earlier this year to Florida and what I saw there. Richard and I focused on forecasting interest rates today. Down the road, he and I talked about having him come back to discuss more about forecasting inflation. So we're going to do exactly that because I know from following Macro Watch that Richard has what I think you're going to find as some pretty surprising and unexpected forces that can conspire to shift inflation in ways that you've probably never thought about previously. As you know from listening to this show, inflation is our friend, and you are probably an inflation cheerleader just like me, since we are fans of long-term fixed interest rate debt. Higher inflation both drives up the dollar-denominated price of our real assets, and then at the same time, it dilutes the weight of our debt. And a lot of this stuff is counterintuitive, just kind of like how higher mortgage interest rates do not lead to falling home prices. Hey, well, thanks to Richard Duncan. He has a lot of charts and graphs where he uses audio for narration over there on MacroWatch. So if you're interested in learning more about how the economy works and about monetary policy and about the history and the forces that affect all this, in that way informing your own predictions based on what you think is going to happen, check out richardduncaneconomics.com. Thanks for the 50% discount on an annual MacroWatch subscription with the coupon code GRE. Until next week, when I'll be back to help you build your wealth, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
If you want to retire in 5 years or less through real estate investing, then pay close attention as I'm about to share my proven recipe with you. This is Brad Sumrock, and I've taught thousands of people just like you how to replace their incomes, quit their jobs, or simply have more income and freedom than they ever thought possible. And we do this by investing in apartment buildings. After starting with no experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job after only 3 years of apartment investing. And I have hundreds of successful students that have had similar results. If you want to get out of the rat race or simply have more income and freedom in your life, then investing in apartment buildings might be the answer for you. Visit our website at bradsumrock.com to get more information about our upcoming training events. That's bradsumrock.com.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.